Chapter number 1: Nature and Scope of Financial Management. Introduction. Finance. Finance is defined as the provision of money at the time when it is required. Every enterprise, whether big, medium, or small, needs finance to carry on its operations and to achieve its targets. So, it is rightly said to be the lifeblood of an enterprise. Classification of finance. Finance deals with the requirements, receipts and disbursements of funds in the public institutions as well as in the private institutions. On the basis of these, finance is classified into following two parts. Traditional classification. Modern classification. Classification of finance in traditional way. Business finance. Public finance. 1. Government institutions. 2. State governments. 3. Local self-governments. 4. Central governments. Private finance. 1. Personal finance. 2. Business finance. 3. Finance of non-profit organizations. Classification of finance in modern way. Business finance. Partnership finance. Sole proprietary finance. Company or corporation finance. Approaches to business finance. Business finance connotes finance of business activities. It is composed of two words. Business, state of being busy related with all creative human activities. 2. Finance, provision of money when it is required. So, business finance concerned with the application of skills in the use and control of money. 3 main approaches to finance indicated in traditional and modern approaches. Providing of funds. Finance to cash. Raising of funds and effective utilization. Financial management and definition. Financial management refers to part of management activity. Planning and controlling financial resources. Finding out various sources for raising funds. Suitable and economical sources. Proper use of funds. So, financial management is an area of financial decision-making, harmonizing individual motives and enterprise goals. Definition. The area of the business management devoted to a judicious use of capital and a careful selection of sources of capital in order to enable a spending unit to move in the direction of reaching its goals. J.F. Bradley. Evolution of Financial Management. 3 stages. Initial stage, 1930. Emergence as distinct field and formation of large-sized business undertakings. 1930 Economic recession creates difficulties in raising finance and find out improved methods for sound financial structure. In early 1950, emphasized on reorganization of industries and selection of sound financial structure. Shifting to profitability to liquidity, techniques of analyzing capital investment and widened the scope of financial management. Modern phase after 1960. Discipline of financial management become more analytical and development of theory, methods, models like CAP, option pricing theory. New sources of finance like PCDs, FCDs, PDs, etc. Importance of financial management. For financial planning and successful promotion. Acquisition of funds at minimum cost. Sound financial decision. Improving profitability. Proper use and allocation of funds. Increasing the wealth of investors and nation. 1. Acquiring sufficient funds. 2. Proper utilization of funds. Aims of finance function. Scope of finance function. 1. Acquiring sufficient funds. 2. Proper utilization of funds. 3. Increasing profitability. 4. Maximizing firm value. estimating financial requirements, deciding capital structure, selecting a source of finance, selecting a pattern of investment, proper cash management, implementing financial controls, proper use of surpluses. Relationship of finance with other business functions. Distribution function, accounting function, production function, purchase function, personnel function, research and development function. Objectives of financial management. 1. Objective profit maximization. Arguments in favor. Profit maximization is the obvious objectives when profit is the main aim. Profitability is a barometer for measuring efficiency and prosperity of a business. To survive in unfavorable situation. For the expansion and diversification. For fulfilling social goals. Arguments in against. Ambiguity. Ignores time value of money. Ignores risk factors. Dividend policy. 2. Objective wealth maximization. Arguments in favor. It serves the interest of all shareholders. Owners' economic welfare. Long-run survival and growth. Consider risk factors and the time value of money. Increase the market value of the shares. Value maximization of equity shareholders by increasing price per share. Arguments in against. Objective is not descriptive. Not socially desirable. Controversial point that it increases firm's value or shareholder wealth. Wealth maximization is difficult when ownership and management are separated. Measuring shareholders' value creation. Economic value added. EVA is a measure of performance evaluation employed by Stewart & Company. It is now used to measure the surplus value created by an investment or a portfolio of investments. EVA equals net profit after tax, cost of capital x capital invested. Market value added. MVA is the sum total of all the present values of future economic value added. It can also be defined as MVA equals current market value of the firm, book value of capital employed, financial decisions and interrelation of financial decisions. 1. Investment decision. 2. Financing decision. 3. Dividend decision. Interrelation of financial decision, investment decision, dividend decision, financing decision. Financial management concern with 1. Financing decision. 2. Investment decision. 3. Dividend decision. Analysis. Risk. Return relationship. To achieve the goals of wealth maximization. Factors influencing financial decision. Internal factors. External factors. Nature and size of business. Expected return, cost, risk. Composition of assets. Structure of ownership. Trend of earnings. Age of the firm. Liquidity position. Working capital requirements. Conditions of debt agreements. State of economy. Structure of capital and money markets. Requirements of investors. Government policy. Taxation policy. Lending policy of financial institutions. Risk-return trade-off. Risk market value of the firm return. Investment decision. 1. Capital budgeting. 2. Working capital management. Risk. Financing decision. Capital structure. Market value of the firm. Dividend decision. Dividend policy. Return. Financial forecasting and planning. Acquisition of funds. Functional areas of FM. Functions of a finance manager. Determining financial needs, selecting the sources of funds, financial analysis and interpretation, cost volume, profit analysis, capital budgeting, working capital management, profit planning and control, dividend policy, financial forecasting and planning, acquisition of funds, investment of funds, helping in valuation decisions, maintain proper liquidity, financial engineering, designing and developing new financial instruments, formulating new processes, formulating creative solutions to financial problems, organization of the finance function, board of directors, managing director, vice president production, vice president finance, financial controller, planning and control, annual reports, budgeting, additional funds, cash management, audit, protect funds and securities, relation with banks and financial institutions, profit analysis, accounting payroll, treasurers, vice president sales, the financial controller versus treasurer. 1. Provision of capital, accounting. 2. Relation with banks and other financial institutions, preparation of financial reports. 3. Cash management, reporting and interpreting. 4. Receivables management, planning and control. 5. Protect funds and securities, internal audit. 6. Investors relations, tax administration. 7. Audit, reporting to government.